look for crown jewel assets that are out of favour. So what does that actually mean? It means that the stock price of these businesses has been flat for a number of years, or is down 30 to 50% near term. We focus on these leading franchises that are trading below replication value or replacement value. And we also look for management's interest to be aligned with us. We also look for a catalyst. The catalyst may take a few years to eventuate, but that's why we're paid to wait, and we get a nice dividend yield to wait as the business normalises over time. An example of this is in the consumer staples area. So what happened? If you look at Amazon, Amazon bought Whole Foods. What did the stock market do? The stock market derated the food companies and also the consumer products companies. So the Colgates of the world, the Procter and Gamble's, the Kraft Heinz and the Kellogg's. And the reason the stock market derated these businesses is they were concerned that Amazon would commoditise food exactly like they did with books, exactly like they did with all of the other products they've got in over time. So what did we do? First of all, we looked at the industry and we only focused on the best assets. So we looked at Kraft Heinz, didn't want to own it. We looked at Kellogg's, didn't want to own it. What we focused on was Colgate and Procter and Gamble. Why? The reason we focused on those two names is they had the highest market shares and they had the highest return on capital. If I can use Colgate as a great example, Colgate's market shares range between 40 and 80%. And I always come back and say, when you have that type of market share, you have pricing power. You're able to innovate. I still remember as a kid, remember when we all grew up, cleaned your teeth, it was white. Now look at the range of toothpaste. It's white, it's coloured, it's got mints in it, it's got natural products. And the difference in price is about $1 all the way up to 14. So from our point of view, there was a opportunity with the stock being derated. It had been flat for 5 years. You had a management team that were focused on getting cost out of the business and giving us a nice 3% or so dividend yield. You knew longer term you had pricing power because they were able to innovate and they were able, due to the large market shares. And at the same time, they'd been hit by an external factor of poor economic and political environment in two of their big markets, which was Brazil and Mexico, which were going through a recession or a soft period. And also they'd been hit by, we would argue, a one-off type of input price effect. So what do I mean by that? I mean oil price had been high, plastic price had been high, all of their input prices due to the commodity environment were high. What does Colgate and Procter and Gamble do? They hedge their input prices for a year in advance. So what we're now seeing is the company come in or develop into an inflection point where earnings should start reverting upwards. Why? Because if you look at the economies post the elections in Mexico and Brazil, they're improving. The currencies in those markets are improving or at least not deteriorating. The hedging profile that was done poorly when oil price was above $70 is winding down. In other words, they're getting the benefit of the lower oil prices today, which means you should start seeing the earnings re-rate from their base over the last couple of years. And again, management have said, we're going to keep costs low and we're going to send all of the free cash flow back to you shareholders via a dividend and buyback. Due to the Amazon threat, the consumer staple space derated. But when you look back at what people were buying on Amazon, it wasn't private label because there's a very low private label in toothpaste. It's less than 10%. What people were buying was the Colgate brands. They were buying the exact same type of brands that they were buying when they went to the shop. The only difference was it was convenient. The prices were very similar, if not the same, and in some cases higher, but it was the convenience of being able to utilise the Amazon delivery. So we sat back and said, look, yes, Amazon has come into the space. Yes, they are disrupting it, but they're not disrupting the brand, they're disrupting the distribution.